In the world of business, not all deals are what they seem. Fortunes rise, empires crumble, all with the stroke of a pen. Mergers, acquisitions, hostile takeovers. Welcome to Mergers She Wrote, where we examine strategies and stories behind the biggest deals in business. Because in M&A, the real risks are the ones you don't take. Welcome to Mergers She Wrote. I'm Paloma Goggins, the owner of Nocturnal Legal and your host. My guest today believes that in order to scale your $1 million business, capital is king. Thank you, Diti Sangoy, for being my guest today. She is the owner and founder of DV8 Ventures. She's a growth strategist with a track record of transforming founder-led businesses into investor-ready enterprises. Thanks so much for being on today.
I'm so grateful to be here. Thank you.
So let's hop in. I know that you work with private equity and venture capital-based businesses. For anyone who is at that, $1 million threshold in their business, crushing it, wants to get to the next level, tell me, what is a way that those businesses become attractive to VC and PE firms?
That is such a good question, and one that my clients ask me all the time. I will say, as we sit here in kind of mid-2025, there is, I would say, probably I'm not going to throw out a percentage, but thousands of businesses, right? If not millions, that are raising capital at this very moment. I think that, and this is why I believe capital is king, because the idea that your business deserves capital and would warrant investment from a VC or a PE firm is wonderful. It requires a readiness that I think oftentimes founders and leadership teams don't have, especially if it's their first time raising. And what I think is most attractive is that level of sophistication, ability to tell your story in a really compelling way, and also track record and results that are not just driven based on top line growth, but actual path to profitability. And I think that last piece about how are you either already profitable or getting to profitability is super important.
So when you talk about telling a story, trying to raise funds, like you said, there's so much competition out there. How do you, become, as a business owner, how do you bring what is arguably of already successful business and compete against arguably a bunch of already successful businesses? And you're talking about the storytelling, how do you transform what is on paper, from a financial perspective into a story?
Yeah, I think number one, there has to be, so I'll take an example of a beauty business, right? And my background is mainly in healthcare, but this is very interesting because I had a client who is focused in the beauty space. And what I recognized about most beauty businesses now is the founder needs to have some level of authenticity. We're not looking for perfection anymore. We're looking for people who relate, who have the same problems that we have and have a passion for solving that problem. I think that is the crux of, or the foundation of the story. And then a lot of what I find really resonates is either I had this problem, I knew people who had this problem, I had a real just desire and fire in me to solve it, but do it in a way where it's again, relatable and different from what's already being done, whether that's a price point, whether that's clean ingredients, whether that's just ability to touch different types of skin, right? There's just so many ways that you hone in on the niche within the broader issue or problem. And then it's, okay, so I started here, but now I have built this team around me that has all these different skill sets that I maybe didn't have as a founder. And that's why we're a force to be reckoned with.
I like this idea of differentiation and being able to rely on the niche, right? Everybody always says the riches are in the niches. I always like that phrase. But so for anyone listening who they're like, you know what, I do need to do this because my business is crushing it, but I'm not capable of taking that, money that I have bringing in and like essentially parlay that fast enough to grow at the rate that I want. What does this process look like? If somebody wants to go down this road of getting an institutional investor to just grow more rapidly, what from point A to point B in its like simpler form, like what does this look like on paper?
Yeah. First off, I'll say I think a lot of people can do it themselves. I think the biggest miss is there's an art to doing it. And those of us that have done it and have raised money or have successfully exited businesses have learned that art. You could take the same exact business and, to your point of what are the steps, run a financial model, put together an investor pitch deck, reach out to a bunch of VCs and PEs that invest in your space or could have an interest, and basically just ask for a meeting. And once you get that meeting with that investor, you're going through kind of the pitch and telling your story, fielding questions, getting an LOI, IOI, some kind of indication of interest, and then moving into diligence from there. So those are kind of the key phases or like meaningful steps in the journey. The way you do that is, I think, the art, and that's what a lot of people miss, which is I could sell the same business for 10 million and I could sell that business for 15 million. Fundamentals are exactly the same. The art is really finding the right investor or buyer for your business, and also building a business that is right for that end target. So I think that's what a lot of people miss in the journey is they're looking to raise when it's like, oh, I just need capital immediately. You really should be thinking about that at least 6, if not 18 months prior to when you need it.
That makes sense. I mean, it's in a way, the way you're describing it is like courting or dating, right? You've got to find the right match. You've got to find institutional investors that are interested in your industry because, like you said, actually, what's a good point, not every institutional investor touches the same industries. Mm-hmm. So I think a lot of people don't realize a lot of, private equity groups will be very focused on industry-specific niches. And so they become sort of quote unquote experts in those spaces and they love to they know the ins and outs. So it's easy for them to make an investment decision as opposed to coming into a brand new industry that they know nothing about. So I think that point that you made about finding a good match, not just from a story and solution perspective, but also from an industry perspective can be so critical. So touch on for just a second the difference, because I know in the traditional M&A space where I, play in the sandbox a lot is private equity coming in and full sale buyout. And I feel like that's, in a small business setting, that's the most traditional way that people hear about private equity, especially right now. It's still hot to be private equity buying trade companies like HVAC and all of that.
Yeah, absolutely.
So, in the industry spaces, I feel like that's kind of the word on the street is private equity is buying us out slowly and surely. And when they're the highest bidder, it can be hard to say no. Whether it's the right decision for that business owner or not, I think it depends on the situation. But, describe the difference between that and what we're talking about today on this episode, which is getting capital from private equity.
So I think both, the crux of both is something you hit on and something I always emphasize, which is timing is everything. So if you, as an individual, a founder, or leadership team, are in kind of that vein of, I want to keep growing this thing. I want to run this thing. I want to own this thing. I see the potential and I want to be part of that upside trajectory. I just need basically something to kind of like turn up the volume and set this thing on fire, right? That is a classic case of, I need that 10, 15, 20 million, maybe even more from private equity to invest into my business. I know how to run it and I want to run this thing to then become a 150, $200 million business. The other side of the story is, I'm happy with where kind of I've grown my business, right? I'm at that $2 million mark, feel pretty comfortable. I want to take my chips off the table and I want to get a nice payout and a check from private equity. And maybe I stay on and I help transition, but effectively, like, I'm good with where we're at right now. And I think that's partly also why I would always recommend engaging with an advisor who can talk to you about your options, because you could be leaving a significant amount of money on the table if you sell too early. On the flip side, you may think your business has a ton of potential and it actually doesn't. And selling now, either based on market dynamics or your performance or, kind of what's happening in the industry, might actually be a better bet, right? So I think people often don't think about all the options that are available to them. And that's what advisors like you and I can help them map out and say, okay, so which one is the best fit based on where you're at personally, but also what the trajectory of this business is.
That is so true. And I think one way to liken this is, from a very simple standpoint, if you're sitting in your home and you're not thinking about all your options, you might have the opportune moment to sell at a peak time in the market and miss out on that because you're just head down and focused on what you have going on. And I think there are people out there that look back and say, oh man, if I only knew that my house was like, 4 times what I bought it for during peak market, and now the peak market has passed. I think that same concept, kind of what you're explaining, right? Which is that having advisors available to you to talk about your options and to determine maybe now is the time. Maybe this last year was financially so good that an exit makes more sense as opposed to doubling down and getting capital and trying to build it even further, because maybe last year was a huge blip and it was a great year for you. So I like that. I like that explanation.
Or technology is going to come in and like revamp your market, as we're seeing right now.
So true.
Yeah.
So I know, you and I were having a discussion before we sat down for this episode, but I would love for you to go in and talk about the difference. We just talked about getting capital from, say, private equity versus exiting with private equity, and how, one is inherently just getting an investment and continuing operating with the same people in place, while as the other is like a traditional M&A exit where you, like you said, might be transitioning them or helping them support in the process of the buyout post-closing. But ultimately you'll be gone at some point in the future. When we're talking about the front end of that piece where you're getting an investment, you had described to me before we sat down, control versus non-control. Can you explain that for those that are listening?
Yeah, absolutely. So I think what people often, and I'll take a step back actually, what people often don't realize is there are many forms of capital and they're not created equal, and they also don't serve necessarily the same strategic purpose. So there are private equity firms, typically less venture firms, but more private equity firms that just want full control of the business. They have operating teams. They know the space in the industry. They've done all their research. They may even just want to fold your business into another business that they've already acquired. That would be like basically a full buyout, as we mentioned, or sometimes even just a control investment whereby they've got more than 50% of the equity in your business. And in many ways, as a result, they kind of call the shots. So while you're still there and you're still operating it, if they decide, hey, we need to pivot in this direction, or we want to rebrand, or we need to bring in this technology, it goes to the board of investors or board of directors, and effectively the number of votes that they have may outweigh yours. So that's a controlling investment. A non-control investment, which most people that are looking to stay in their business and grow their business, is again just simply less than 50%. And even with that, there can be clauses. So you have to be really careful, because there can be clauses in agreement terms whereby over time, certain investors are either allowed to double down on their investment, buy more, or you as the original founder get diluted down. And what that means is you could be at 50, 60, 70%. And as other investors come in, unless you're somehow co-investing, your piece of the pie is getting smaller and smaller. These are all things to consider, because if ownership and control is really important to you, you want to be very careful about how you're structuring these deals and making sure that it's not just a what percentage do I have today, but what could that look like in the future?
100%. Could not agree more. And I would say too, from a legal perspective, the structure, right, is it comes down a lot to your organizational documents. So, people will think of the investment as just this one-time transaction. And in reality, you're actually renegotiating a lot of times with investors, whether it's private equity or not. And when an investor comes in and they're renegotiating your operating agreement or your bylaws or your shareholder agreement, and all of a sudden you have a board that's half people that you don't know, and like you said, there's priority of first right of refusal, or ability to create essentially preferred versus non-preferred classes of voting. People always say like, well, I always love it when startups come to me and they're like, I'm going to do, preferred and non-preferred classes of stock. And I always ask why. Yeah. And they're like, well, at some point I want investors. And I'm like, so you're giving them a head start because they're going to want the preferred. Absolutely. Like they're never going to come in and not want the preferred. They're going to want you to have the non-preferred. Yeah. And then, everybody has to put a pin in it and be like, wait, do we not understand the difference between voting rights? And so I think you made some really solid points there, which is that this isn't just about obtaining the capital. You also have to be able to think, smart, be defensive, and make sure that when you're signing on the dotted line, all the terms and conditions, the fine print of what that investment really means.
Absolutely. And I will double down on that point, because I've actually seen a lot of fodder on LinkedIn lately about early stage investors in startups, like angel investors, et cetera, that are saying, I ended up with nothing, right? Even when this went to IPO, or even like the success story all the way, because of the way that either they couldn't continue to keep their investment percentage in line and they got diluted down, or after the preferred investors and after, the transaction fees and all the other items on the list, like the debt, they had nothing, right? So I think that is probably the biggest shame in the industry, is like your early believers were left with the smallest piece of the pie.
Yeah, no, that's so true. And I think too, there's some sort of, I don't want to say it's positioning, because, well, maybe it is a little bit of positioning, but when you have, say, an operating agreement that gets renegotiated by a heavyweight investor, and they restructure the distributions, even if you don't lose out on your percentage, those distributions could be drafted in a way where when you used to get distributions every time that the company took distributions, all of a sudden you're at the bottom of the waterfall and it's all dried up by the time you get to the bottom. And so I do think people have somewhat, I think when anyone's talking about capital, they get stars in their eyes and sometimes lose sight of the fact that their ultimate goal should be control, retaining control of some form, especially when they want to grow and continue to exist within their company. Because what's the point of it all at the end if you come out with nothing?
Absolutely. And taking care of your employees, right? Like some of the early people that were in there in the trenches with you, same thing, right? If you've given them an equity piece, but they're common, or they're, lower in the kind of tranche, then they may not get left with much. And they've probably been working in that business for the equity and the upside.
Yeah, all the people who did the sweat equity at the beginning and don't actually get to cash out at the end. Yeah. No, exactly. Well, I know, based on your background, you have participated in and been a key person in this successful 8-figure business exit to UnitedHealthcare. I'd love for you to tell that story, and then tell us too, like, what can the smaller business owner learn from what you went through in that process?
Yeah, I think the biggest takeaway from that story, and I like to start with this at the top, is not all growth is good growth. So people just think, oh, I'm growing so fast, I have like 10x, 15, 20x, whatever growth, top line. That doesn't necessarily mean that your business is actually sustainable nor doing well. And that for me was a huge lesson through the process. So The business that I'll back it up. I have had the good fortune of both working for institutional investors like JP Morgan and BlackRock, but then also being recruited by much smaller investors that are still institutional, like venture and private equity firms, to then be in the trenches as a senior leadership member within their portfolio companies. And this was that case. So I was brought in as chief strategy officer of a healthcare services business. The business had been growing tremendously, and they actually recruited me to help them raise a Series B. So they had raised $20 million from a venture capital firm, and because they were growing so fast, that money was obviously not lasting, and the runway was starting to run out, and they needed to raise again. The market, when we started to raise, was pretty frothy, especially on healthcare, and there were talks of this business being valued at close to $500 million, which is significant. That being said, as I was kind of liaising with our investment bankers, and over time, as kind of months were progressing, and this was around 2021, 2022. So post-COVID, healthcare was super hot. And then it was like, let's rethink some of these valuations a little bit. I started to see that what the founders were looking for from a valuation perspective on the Series B was probably not realistic. In addition to that, the cash position of the business was starting to become precarious. And I think that's another key point. It always takes longer to raise capital than you think. So many people think, I could have capital in 3 months, 4 months, 5 months. You could, or it could take 6 to 9. And anytime an investor sees that you are capital constrained and that maybe you're even going to run out of operating cash to run your business, now they have leverage. So what we noticed was, okay, this is now starting to look like a much tighter window, given that several months have gone by and we have not found someone to raise in the right way at the right valuation for the B. And that's when I suggested, along with, kind of talking to our founders, our leadership team, and the investment bankers, that we pivot and start thinking about strategic exit. This was a clear case of we had grown, I would say, probably well over 10x. And the cash flows of when we would collect money in versus had to outlay capital did not align. Mm-hmm. And so effectively, we'd grown over our skis and didn't have the capital to support that growth. When we started talking to strategics, the story was very different because they, A, have very deep pockets, but B, understand that that growth is something that they absolutely want and can operate through. Private equity often wants to put in capital and they want it to be as less capital intensive, but high growth. Whereas a strategic, especially in the healthcare space, can often put up the money and then wait and let the growth come in. And so it was definitely a much better fit and a better strategy for us at the time. We had a couple of different, we kind of went through the pitch process. We had multiple upfront meetings with different strategics. Eventually we had 2 or 3 that were serious and had submitted meaningful LOIs, and one of which we went exclusive with. The diligence process was incredibly difficult compared to what we thought. So to give you a sense, our leadership team was 6 people. The first diligence call that we got on with UnitedHealthcare, we asked how many people from your side, should we expect? And they had said probably close to 100 people.
Holy smokes.
Because they have so many departments that this one acquisition would touch, that they needed someone from every single department to be on the call. So these are the kinds of things that I think so many people underestimate, right, when they're going through this process. And it's how do 6 people match the litany of questions coming through from all of these departments and hundreds of people on the other side. The deal, thankfully, I would say we were just incredibly responsive on diligence, partly because we knew we had a dwindling cash position and needed to kind of thread the needle. And thankfully we did. So in under 6 months, we successfully completed diligence. There was definitely some negotiation of the initial LOI. And that's the other thing I always tell people. What is written in the initial LOI versus what the terms and even the valuation will look like by the end of the deal is likely to be different. So prepare yourself for that. But it was still a really good outcome for both existing investors as well as the founders and the leadership team. And the business was acquired and integrated into UnitedHealthcare and their Optum division.
Nice. I think it's worth saying that even in a private equity buyout, I think people can underestimate how intensive that diligence process can also be. It doesn't just have to be like the conglomerate giant corporation that comes in and inundates you. Although I think 100 people on a phone call is something I have yet to come across. So that is absolutely bananas. But like I closed a deal in April where they, hired a heavy hitting law firm. It was a private equity group. Most private equity groups have heavy hitting law firms. And, we went on a diligence call and they had 10 attorneys from 10 different departments. And, I've got my one founder fielding questions from HR to, benefits and litigation. And I mean, he gets done with the phone call and he's like, I'm exhausted.
Yeah.
So I think, businesses, to your point, that grow really, really large, successfully wise, and then maybe don't have a really large C-suite team or executive level team, aren't always prepared for the level and depth of diligence that comes with such a large transaction. So I love that point. I want to back up for just a minute for anyone listening who doesn't have the background knowledge of LOI stands for letter of intent. You also mentioned IOI. Go ahead, tell everyone what IOI stands for.
Indication of interest.
Very similar concepts. Yeah. You had mentioned the word strategic buyout. What would make something strategic? Like why call it strategic?
I think typically when I think of a strategic buyout, maybe it's just a fancy term, but effectively it's somebody who is larger, most likely than your business, and has some use, purpose, ability, strategy to take your business and incorporate it into what they're already doing and their existing strategy and create multiples of value off the back of that. So it's your business as a standalone entity has its value. The strategic is part of the nature of that is they can then multiply that value based on who they already are and their strategy.
I could not have said it any better. That was great. Okay, and then to kind of come full circle on your story, you had mentioned originally looking for Series B funding. For anybody who's not familiar with the ABCs of funding, what's the difference between seed, a Series A, and a Series B?
That is a great question. And even I would say, in kind of investor circles, that there's no clear cut, like hard lines between these things. But where I always think people start is some kind of angel or seed investing. That effectively means friends and family. Often before that, actually, you've probably bootstrapped the company, right? So that's like number one, no outside money. Then you've got some outside money, which could be friends and family. It could be what is called angel investors that are just early stage believers in what you're doing in your business. And from there, when you move into Series A, I typically think of that as now that's a transition to something institutional. So a Series A investment, and then from there it goes B, C, D, could go to E, then IPO, is effectively just additional rounds of funding that typically get larger and larger. The valuation you hope is going up, but in some cases, and this is a key point too, could be a down round. So you could actually have a valuation come down from what it was in a previous round. But essentially, as you kind of go up the chain of letters, you are bringing in larger and more sophisticated institutional investors the diligence can be more intense. But a great point that you mentioned is sometimes investors that are writing checks that are, $1 million, $2 million, are conducting just as much diligence as someone who's writing a $20 million check. So I think the ethos on diligence has changed really significantly from what it used to be.
100%. And I will say this too, for anyone who's considering, the angel investor route, right? The small group of wealthy individuals who are just looking for, outside investment opportunities. Sometimes I think people will assume, setting aside the diligence piece of it, they'll assume that they're, investors because they're more like friends and family, even if they've just met them, will be an easier sell, or they'll be easier to deal with as investors because they're just normal people like you and me, as opposed to an institutional investor. The disconnect I see a lot of times with my clients is that those angel investors or the seed round funding, especially if it's friends and family, they're not sophisticated enough to know quite how business works, and that you have to weather the storm. And so you get these random questions of like, when can we get our money back? Why are you showing a deficit? All these questions that you're like, don't worry, we've got it under control. But like, also, this is not how this works.
Yeah, I think that's a great point. I would say this is also why it's really important to know effectively who you're getting in bed with, because you may think that either there's a number of variables there, right? Level of sophistication of the type of investor that you would want. 2, I would say, is time horizon and how patient is that capital. And 3 is risk tolerance. Because exactly as you said, some of these investors are like, wait, why is everything like valued, now if you, and these are all paper valuations. It's not even real money that's like moving hands, but it's like, oh, I thought this was going to be like a, 2x return or a 30, 50% return. And now I'm only seeing like 18%, and it's like, but it means nothing. Because until you've had an exit, or until you've had a recap, or like an additional investment come in at a different valuation, it's just paper money.
Well, and I think too, to parlay off of that, people always love, because of the low hanging fruit of friends and family as their first round of investment, but people underestimate how much money changes relationships. And
Absolutely.
so, I mean, it's true even in, business partnerships, right? Where both people are contributing capital to just bootstrap it, is that money really can change the dynamic. It can change people's perspectives. The minute that the business really starts to take off and revenue gets generated at a level where, holy smokes, like this is something real, people all of a sudden can get greedy. They can get angry that they're, carrying a lot of the weight of the business. Someone's maybe doing less. And so I always warn my clients when they're looking for their first round, or they're looking to get into business with a sister or a best friend or somebody, I'm like, this is arguably more complicated than getting an institutional investor in some ways, because you have all these trappings of the relationship and not wanting to ruin that, and what happens when things go south or they don't go right.
Yeah, I would totally agree. It actually reminds me of a prospect call that I was on, and I had spoken to one of the partners pretty significantly, and then he was like, okay, he had a very clear vision of, hey, we need to bring in this outside capital because a business can do X, Y, and Z, and we need to hit like within this time frame, et cetera. And he was like, okay, I want to bring my partners into the conversation. And I have learned from that conversation that it's best never to assume that everyone is aligned. So I went into that thinking, okay, I'm just here to kind of pitch how I can help them, like both from telling their story, finding the ideal investor, getting through diligence, and ultimately securing the capital. As I kind of was, getting into like, hey, here's what I've discussed with so-and-so, and I realized the other 2 investors both were just not on his page, but not even them on the same page. Oh. So one felt like, oh, we can continue to like put in our own money to do this. We don't need to get institutional money. The other was like, oh, I don't even see why we need money at this stage. Like we're fine kind of petering along as we are. So it just it was a great learning experience for me, because when there are partners, whether that's family, whether that's just business partners, whomever, a big part of it is, are you even aligned on the vision and what the right strategy is to meet that vision? Because I also think, in their conversation, one is saying, oh, I think we could sell this business in 3 years. The other is like, no, I want to sell it like in a year, right? Very different. And what you would do as a result of like what your ideal outcome is, like today, what you would do is completely different. So I think, yes, the more, as I say, cooks in the kitchen, it can be pretty difficult. But I also think that having that alignment is critical, because especially if you're going to get in front of an investor or someone and you're not aligned,
yes.
I mean, you've lost the deal immediately.
Oh, yes. No, I think that could quite possibly, between going in front of an investor and not having your story straight and going in front of a client and not having your pitch straight, I think those are two like the worst things you could possibly be doing as
people
partners.
do it. Yeah. And sometimes it doesn't even come out until someone pushes the button and asks the right question. And then you're like, wait, what's going on?
So true. And maybe that underlines a more soft topic of this whole episode, which is that communication and the ability, back to storytelling, the ability to convey not just to your potential institutional investors what you do in your business, but also convey to your partners what you want from your business and what that looks like, which can drastically change what you're going for. Because like your story, exemplifies, if the partners don't want to bring on institutional capital, then your idea of growth is totally different.
Yeah.
So you talked in that story a little bit about what you can do for clients that work with you. Mm-hmm. Please just expand on that. Like, the 4 kind of key concepts that you brought up in that story.
Yeah, absolutely. So I think for me, what I always tell all my clients and what I kind of learned through my career is that my MO in everything is growth. So I literally, this is funny and a little tangential, but like I will go to my hairdresser and she'll be talking about her business. And I'm like, have you thought about doing this? And like, oh, what about this avenue and this customer base? And so I'm just wired to think about how do we grow, whatever it is. So thankfully, having had a background in finance, management consulting, and sales, I kind of understand a lot of what it takes within a business to grow. And so I would say the ways that I typically engage with my clients is people that know that their business has the capacity to grow and scale well beyond what they're doing today. That is kind of A, ideal profile. B is somebody who's already got an established product or service. So yes, I've done product development or helped with pilots and things, but really my sweet spot is you've done the journey from 0 to 1 or 0 to 3 or 0 to 5. You now know that journey should be 10x of that. How do you get there? That is the functional skill set that I would say I bring to my clients, which is what are the things that are really going to help you scale your business? How do you double down on those? And what does that investment look like? And then from the back of that, so why does it make sense to have capital infused into the business right now? If you got that capital, what effectively would that unlock in your business? And then how do we tell that story to an investor in a compelling way so that they see that they're just effectively, putting gas on something that's like already doing well, but it's accelerating growth. I think that is really the strategy piece of it. And then as a byproduct of that, how do you secure the capital and the mechanics of doing that and that whole fundraising process is what I love to help my clients do. Because again, I believe capital is king. And I believe that many, many businesses I've seen over the years, the ones that are successful, ironically, are the ones that have had the luxury of capital to be able to pivot. So we all make mistakes. It's the business that can say, okay, I have product A, but now I'm just going to do like version A.2, and then I'm going to try version A.3. They probably will fail the first 3 or 4 times, but if they've got enough capital to keep iterating, you're likely to hit something. It's the people that don't have the luxury of capital where I see tons of businesses that have tremendous ideas and even great execution, but they run out of cash. So that's where I would say recognizing that you've got something that you believe in that could scale, knowing early enough that you should start thinking about what's the long-term strategy and when the capital should be infused into the business, and then building today to court that investor, as we said earlier, so that you can successfully raise when you're ready.
I like the story that you've essentially pieced together here, which is that failure is really just the path to success in a lot of cases. Because I feel like so many times, if you're not the serial entrepreneur, right, which is addicted to this process and will at all costs try and succeed, even if they've failed a million times, if you're just someone who is inclined to start a business, and I feel like there's kind of two camps, right? I mean, no matter what, you're an entrepreneur, but I feel like there's the I'm going to keep doing it until the day I die entrepreneur. And then there's the entrepreneur that gets dissuaded by how difficult things are. And that's why we have the statistic, that so many businesses fail within the first year, let alone first 3 years, right? Most people don't make it to year 3. But I like this idea of like as long as you have the bandwidth financially to learn from your mistakes and create new iterations or pivot, that it's just a matter of showing up, right?
Yeah, because it could be that your pricing is wrong. It could be your branding is wrong. It could be, it works for this market, but it would work even better for that market. Most people, when they develop something, it's not like, there are very few ideas that I'm like, that's just horrible. Like nobody's gonna, give you money for that. It's most of the time it's, you've got an idea and you either need to like have enough data points and be able to test it to get to the right thing, and this is why I say like a lot of my clients are in the healthcare space because that's my most recent background. But I tell them like my skill set is a functional skill set, which is how to scale. And that is, to your point, if you're a serial entrepreneur, you know how to scale a business, most likely. But if you're not, and you're a kind of industry expert or you've solved a particular niche problem, the way to scale that is not in your wheelhouse. And that's why I would recommend, whether it's me or somebody else who understands that phase of the journey, because it's a very different skill set. And as I say, it's a functional skill set, not an industry or problem specific skill set.
Yeah, totally agree. And I was going to say, I mean, pretty much any business owner that has the idea that they can continue to do the walk alone, I think is going to find that the walk is exceptionally steep and perhaps treacherous, because there's so many blind spots that advisors that have the knowledge that can guide and direct people who are in business, not only to avoid pitfalls and liabilities, but also to position them better for opportunities for growth, which ultimately translate to a better exit down the road. It's kind of that irreplaceable idea of like, you should have a mentor in your business, right? And if you go it alone without mentorship, you're going to have to do a lot to figure it out on your own, which there might be people out there that are shortcutting that system because they have people showing them the way.
Yeah, I would actually add to that point, which is, say you think you could figure it all out, which again, I think that's actually some of the challenge with founders is like, they're incredibly smart and they probably could figure it out. I always think of what is the best use of your time? Is the best use of your time to be invested in your business and in front of customers and in front of like your sales team, your ops team, driving that business forward? Or is the best use of your time to be raising capital? And what I find is that raising capital is maybe not a full-time job, but a part-time job for at least 6 months, if not longer. And so can you afford to be away from your business while, you're doing that? I think that's a huge misstep. So I would always say, like, even if you think you could figure it out, are you better served investing in your business and staying that track and having somebody else who is effectively managing the whole raise process for you and pulling you in as needed? That's kind of the calculus that I do, where it's like you could go, take this $1 million business and help bring in another $500,000 over the next 6 months, or you could be busy raising capital, which you may or may not be successful.
So true. And I think that same concept applies even when going through a full exit, is that a lot of people don't realize how labor and time intensive the diligence process is.
Yeah.
And so a lot of people don't anticipate that, oh my goodness, I'm now running my business and going through the entire diligence process, which if you haven't been doing good housekeeping, you've now got to go back. And I mean, I've had clients before where the diligence period hits like a ton of bricks, and they've got 4 assistants spending their entire day scanning paper documents. And I'm like, we could have prepared for this better. We could have done this better, right? It is what it is now, but I always am trying to like impress upon clients that have this future goal of exiting is that there's so much that can be done in advance. And the same goes for raising capital, you can either head into it with, one training wheel on and the bike's on fire, or you can head in smooth sailing, no training wheels, and everything's shiny and great. So
yeah, and I also think, again, it's part of it is, which hopefully makes it real for people, is the dollars on the table, because during diligence, you're likely going to get knocked down on value. So the more buttoned up you are in diligence, and the more you're like, yeah, we already have that compliance thing, or yeah, we already, the more likely you are to have like leverage in the final negotiation of the transaction. And so, it's always hard for people, I think, to preemptively put out the fire, right? Because they're like, oh, there's no burning fire, I don't need to do this. But I would say, like, if you are, starting to think about selling, or you're starting to think about raising, that at that point, you better push the button of like, find somebody who's done what I'm doing or about to go do, and like knows how to do this.
Well said. Well, I appreciate all of the insights you've shared with us today. As a closing question, is there any podcast or book or something that you would recommend to a business owner that's thinking about raising capital or scaling their business?
Yeah, one that I love and that I think is actually not as well known as it should be is Stephanie Melodia's, it's a podcast. It's called Strategy and Tragedy. And it is brilliant. Pretty sure she's from the UK, so her accent's great. And the stories and the guests are phenomenal. So that's one I would recommend.
Awesome. Well, that statement is going to work perfectly because our episode that's going to air right before this, the guest has a British accent, so that'll work great.
Right.
Well, thank you so much, Diti, for coming on. Thank you for listening. Feel free to comment below any questions you might have, and tune in next time.
Thank you, guys.
In the world of business, not all deals are what they seem. Fortunes rise, empires crumble, all with the stroke of a pen. Mergers, acquisitions, hostile takeovers. Welcome to Mergers She Wrote, where we examine strategies and stories behind the biggest deals in business. Because in M&A, the real risks are the ones you don't take.